that, because this topic was so lengthy, I broke this into today's class and Thursday's class. The chapter we cover will be chapter 8, net present value and capital budgeting. 8.1, incremental cash flow. 8.2, we're going to show you in today's class example of how capital budgeting would work, and I'll show you how to do the calculation in class using Excel. Inflation and capital budgeting, I probably won't have time to get there, but we'll save that to next week. It's similar to 8.4, 8.5, and 8.6. What I would suggest is, please read the chapter, because this case is a pretty lengthy case, the Majestic Mulch and Compost Company. I'll go over the necessary steps to do it here in class. If you're lucky you catch everything, great, but most of the time you need to go back and revisit this case, because next week is even going to be harder. Today I'm going to show you a simple approach to calculate net present value. Next week we're going to use something called CCA tax shield, which is a very specific approach. It's based on everything you learned today. If you don't understand everything that's happening today, you're going to struggle next class, which is Thursday. All right, let's talk about incremental cash flow. So remember last week we talked about the concept of net present value. What's the purpose? Ooh, what did I do? Sorry, I accidentally shut this off. Sorry guys. I guess I can go without the screen. Just restarting. Can someone remind me, or remind the class, what's the purpose of calculating net present value? Yeah?
To see if you should undertake a project or not.
Correct. Simple as that, right? It's finance. What's the value of this thing? We're trying to evaluate something, right? And that's what we do in finance. So the concept of incremental cash flow, these are the cash flow that changes as a direct consequence of whether or not you're going to accept the project. So take a look at this here on the right-hand side. It basically encapsulates the concept here. What will the cash flow be with investment in the project? So if we do agree to take on the project, what will cash flow look like? Versus what happens if we don't take on the project. So last week we talked about the simple calculation of NPV, but here the concept of incremental cash flow is comparing two things. Whether we take on the project or we don't take on the project. The differences between these two options will be the incremental cash flow. Okay, so the development of a plant, here's an example. A development of a plant on land currently owned by the company versus the same development on land that they do not own, that must be purchased. So here's the decision to make. Should we build a plant on the land we own, or should we build the plant on the land we don't own? So two options here. Which one's going to give us a more positive NPV? So that's the value. And the bigger question here, again, yes, it's very operational what I want to show you for the rest of the class. But I want the class to keep in mind, what's the purpose of this? Again, why are we doing this? The idea here is corporate firms. Why do we, okay, so I guess going back to the question, the big question. A great answer, we use NPV calculation to figure out that we should accept the project. So why should we accept the project when there's a positive NPV? Why do we bother accepting a project? Yeah?
It adds value to the firm.
Yes. So what's the deal about adding value to the firm? Why would we care if we add value to the firm? So I'm just pushing. It's a couple whys. Why do we care? Sure?
To maximize valuation.
To maximize the valuation, but what's the deal with maximize? What's the outcome of that? Yeah?
Isn't it increased stakeholder contribution?
Not necessarily contribution, but yeah, we're maximizing the value of the firm, hence maximizing the value of the shareholders. But ultimately, what's the bigger goal here? Anyone? What's the purpose of finance again? Yes?
Attract investments?
Yeah, you can attract investment, but then what's the outcome of attracting investment?
Higher profit?
Well, profit is driving the investment. So ultimately, this is funny, this is interesting because, again, I want to bring you back to the big picture thing and why we're doing this, why finance is important. I asked once upon a time, I asked a graduate student, it's like, why do you study finance? Well, I want to make money. there nothing more than just making money? There is, right? Remember there's a slide I showed you? What's the wealth of a society? The wealth of society is an aggregation of all the value of the assets, right? So you want to be able to continue to add value to firms, hence the aggregation of all the values of all the firms, say Canada or Ontario, then that's a wealth of Ontario or the wealth of of Canada. That's how you build wealth for society. So ultimately, this is for the good for everyone, right? You want to be wealthy, you want to be prosperous, and that's how you grow, okay? So that's why as a CEO or CFO, you're making decisions to continue to add value to the firm. And there's many projects you can invest in, right? I was using my silly example as running an ice cream shop in the corner of, Morningside and Military Trail. I have to make a decision. I already have an ice cream shop, but the decision is, should I replace my old ice cream machine with a new one? What's the deal with the new one? Maybe it makes more ice cream, it makes tastier ice cream. Then ultimately more clients gonna come, more profit I'm gonna make, and more value I'm gonna create for the firm. So that's the decision I have to make, whether to replace the machine or not to replace the machine. And how do we do this? The big picture here is we project future cash flow to see if this project is worth undertaking. There are many options, but which one should we take? Now, however, isolating the cash flow that matters can be confusing, okay, because of these four things. And this is an important concept that is mentioned in the chapter. The way I would test you is I would test your understanding of these four different things, all right? Starting with sunk cost. What is sunk cost? Sunk cost is the past costs that have already been incurred and are not changed by accepting or rejecting a project. All right, remember, how do we calculate net present value? We take all necessary cash flow and we try to figure out what the value is today. But sunk cost is something that has already happened, whether you're gonna take a project or not, you already spent. A silly example would be, I was looking for that ice cream machine. I have to drive all the way to Brampton. I have to visit the factory, talk to the owner, learn about what the machine can do. But at that point, I still haven't decided if I'm going to buy the machine. So that cost, that time and gas money that I spent to go there, there's no way I can recover, whether if I'm gonna build the machine or if I'm gonna buy the machine or not. So that's considered sunk cost. They're not relevant to whether we should accept or not accept the project. It is independent, okay? You will see this in the question because in the final exam or in the assignments that you see or practice question, these are all scenarios. These are options that are provided to you. Should you do this or should you not do this? And sometimes they would give you these distractors, such as sunk costs. Like, oh, this person drove all the way to Brampton, spent $500 checking out the machine, but that's not going to be used to be calculating your net present value because it is a sunk cost. The other things, such as opportunity costs. You also look at other opportunities that you will have to forego if the project is accepted. Remember, I was talking about whether I should get the ice cream machine. But what happened is, if I only have enough money for the ice cream machine, there's an opportunity cost. Maybe there's a sandwich machine that I should buy for my shop, but I'm gonna forget that and only go for the ice cream. So this is an opportunity cost that I have to give up. Side effects, though. Side effects are impact of the project on any or other areas of the business. For example, cannibalism. So if I have multiple projects in my shop, if I have a new ice cream machine, people, yes, I can predict how many ice cream I can sell, how much I'm gonna charge it for, but then I'm taking away customer from my existing business. Maybe my drink business, or maybe my slushy business. All right, so that's cannibalism. It's very difficult to estimate. I don't know how many people would actually buy the ice cream and not buy other existing products. The other thing could be synergy. Increased cash flow in other business areas. Just because I have these new ice cream, people will come in and buy some other stuff as well. I have no idea. So these will be very, very difficult to project. Lastly, you have allocated costs. So these are expenditures that benefit a number of projects. So example would be, for me to install this new ice cream machine, I have to install new plumbing, new electrical wire. But these electrical wiring and plumbing is not just serving that machine, but that also build capacity for me to expand that business for some other machine that I would need later on. But how are you gonna split that cost, right? That is something that you would probably have to consider as well. However, allocated costs should only be viewed as cash outflow if they are incremental costs to the project. So again, if that electrical or plumbing cost that is associated with the ice cream machine, I would include it into it as an incremental cost. Okay? So these are these ideas. Make sure you read them in the chapter, elaborate a little bit more. But again, these things will distract you from really isolating the cash flow that you really need to calculate net present value. All right, so I talked about the differences between finance and accounting. All right, in finance, we care about cash, 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 only cash flow. What that means is the physical, not physical necessarily, but the actual transaction. If I'm paying, I'm writing someone a check, is a cash transaction. If I'm receiving money, I got to see the money, show me the money, right? So cash flow, especially the statement of cash flow, is reporting the statement of cash flow. Finance professionals, especially analysts, will care a little bit more about that because we look at cash transactions. What is included? Only cash events that happen. On the other hand, accountants will pay a little bit more attention to the accounting earnings, which comes in the income statement. If you'll recall the income statement. Top line, you have revenue, bottom line, you have net income, and in between, there's a whole bunch of stuff. So can you guys name some of the non-cash items that you would see in an income statement? Do you remember? Yeah. Sure, depreciation. Anything else? Yeah.
Current tax.
Deferred tax, not current tax. The current tax is something that you pay, right? Deferred tax, or tax asset, or tax liability. That's a non-cash item. Anything else? But that's amortization or depreciation. They're pretty much the same thing. Anything else? Anything that's non-cash. What about accrued income? Right? Account payables, account receivable. Sorry, that's not it. Accrued income. So these are incomes that you have yet to receive, but you recognize in the income statement. I talked about the example of Rogers or Bell. When you sign a 24 months contract, right? They actually record your 24 months, but in fact, they only charge you once a month. So these are income that they recorded, but you haven't received the cash yet. So these are some examples of the non-cash items, all right? So we're looking at cash. We're gonna use this example called Majestic Mulch and Compost Company, MMCC. This full length of the case is being discussed in the chapter, so please read it. Here I'm gonna break it apart and show you how this is done. So in order to calculate capital budgeting, ultimately to decide whether we should invest or not invest, we're gonna create and break this down into OCF, operating cash flow, investment cash flow, incremental cash flow, and ultimately we're gonna calculate NPV and IRR. So all these ideas are based on the previous course. You should be very comfortable using the calculator. Although in today's class, I will show you how to do this in Excel. In the exam, it's pen and paper. So you guys would have to figure out how to do that by hand. So before we even begin, in capital budgeting, the hardest part is not the calculating part. But then for you guys in the test, you would think, oh, that's the hardest part. But really, in real life, people do this on a day-to-day basis. The hardest part is to make projection. Whether we should accept the project or not, it's based on assumption. If I get this machine, this ice cream machine, I have to predict how many people will come buy this ice cream, how much do I have to sell it for, how much will it cost me, and I have to project that for many years in order to figure out what the expected cash flow will be in the future. No one can predict the future. So that's why this comes from your expertise in the business and trying to accurately predict what's going to happen. So in the OCF table, you're going to see a few parts, including production forecast and capital cost allowance. Capital cost allowance is another word for depreciation, and I'll show you how this is done. All right, so before we begin, allow me to turn your attention to Quirkus. In Quirkus, I have uploaded the case, just in case you don't have the textbook with you here. But again, the textbook has the full case and examples and everything, but this is basically the story. In your final exam, you'll see something similar to this. I'll give you a giant paragraph, and that's why it's hard. I looked at the last couple of years' final exam questions, and all in similar style. long questions. You're gonna have to read through everything to understand the scenario in order to construct this capital budgeting framework. These questions can easily take up half an hour. All right, sorry. Excuse me. No, it's seasonal allergy there. All right, let's start with the case. Majestic Mulch and Compost Company. You guys know what a mulch and compost is? They use on landscape, put on the gardening. These are compost or mulch. So they are considering investing in a machine that produces something called a power mulching tool. I don't know what that is, but it's a machine that they will produce. A machine that will produce this tool. The cost of the tool making machine is $800,000, and the machine has an estimated before tax market value at the end of 8 years of $134,000. All right. So most machines have expected lifetime. You bought it for $800,000, and then after 8 years, you can run multiple times, produce many products, and you can imagine that by the end of 8 years, you can sell it as scrap. $134,000. That's what you get back. Production by the year during the 8-year life of the machine is expected to be as follows. So there's 8-year lifespan. First year 6,000 units, second year 9,000, 12,000, 13,000, etc. So again, this is something that you would have to predict as a manager. Now, looking at this number alone, do you see any trends here? Again, these are just common sense, all right? Common sense. What's going on here? Like, looking at the number, what do you expect? Is there any interesting pattern you see here?
Peaking and then going.
Right. Starting slow, peak, and then it would decline. So again, I can't argue anything about this being right or wrong. It's provided by the case. But then common sense tells you that this logic can apply in any other business, right? You have a new product, market is new to it, start to pick up after a year, 2 years, and then people find out, oh, this is a good product. So more and more people are gonna buy it. However, if it's a good product, you're gonna have competitions. So all the other factories are gonna do the same thing, or eventually the trend is gonna fade. So you would expect that, okay, now demand's gonna slow down. And eventually after 8 years, maybe there's something newer that's gonna replace this. So we'll be done with this project. All right, so you can see it grows and it declines. Now the price of this power mulcher in the first year is $100. That's the sell price that they decided. The power mulching tool market is highly competitive. So the manager believes that the price of the power mulcher will increase only 2% per year. So first year is selling for $100, next year is 102, and then 2% increase every year after that. As compared to the anticipated general inflation rate of 5%, so there's inflation, which is 5%, which would translate into the material cost. You need to buy raw material to produce this power mulcher. And hence, because of inflation, it's going to get more and more expensive. The variable production cost outflow is expected to grow at 5% per year, which is in line with inflation. The first year variable cost will be $64. So $64 would probably be raw material, labor, and everything that goes into the machine, and grow at 5% per year. And there's also a fixed cost. So the fixed cost, I don't know, maybe it is some parts replacement of the machine or whatnot, $50,000. The tax rate is 40%. So a whole bunch of information. Now, moving on to the third paragraph. Management believes that the investment in different items of working capital will total $40,000 in year 0, stays at 15% of sales at the end of each year, and falls to 0% by the project's end. In other words, the investment in working capital is completely recovered by the end of the project's life. So, can I draw your attention here? Out of the entire question, everything makes sense so far? Most students trip up on this paragraph, all right? This is the hardest part of the entire question in terms of concept. So let me ask you, what is working capital? We talked about this in week 3. What is working capital? Anyway?
Current assets minus current liabilities.
That's the formula of it. So let me remind you, working capital is current asset minus current liability. So What does that mean? Yeah.
It's how much you have to pay your short-term obligations.
How much you time? Okay. How much you have to pay for your short-term obligation? Yes.
Since it's the capital allocated for operations,
Capital, yes. But how would you explain that to a 5-year-old? You have a business here. You want to purchase a machine that makes this gadget that you want to sell in the market. Why do I need working capital? What is working capital? You have to understand this, all right? If you do everything by formula, yes, you can probably get the correct answer, but it's not going to help you in understanding how the whole thing works. You want to try?
isn't it just the money for the new transaction?
So why do you need money? Why do you need money? Why do you need working capital?
Isn't the money for operating business?
Such as? Yeah.
Daily expenses like electricity, bills you have to pay.
Yeah, that's the cash that you would need to keep the lights on. So remember in the case, right? You have a machine. The machine costs $800,000. You bought the machine's here in the plant. Then what? What else do you need to get the machine to work? You need money to pay for labor. More importantly, raw material. Machine doesn't just turn on by itself. You need to hire people, pay for electricity, pay for raw material, and the raw material is short-term asset. So in the beginning, in year 0, you need $40,000 to start operating. That's the initial working capital. So then every year is a rough estimation of 15% per sales. So you imagine, the higher the sales, the more energy, the more people you have to hire, the more raw material you have to buy. So in this case, they use the 15% of sales to estimate the amount they would cost for working capital. Okay? And at the end of the project's life, it falls to 0. Why? Why? It has an 8-year lifespan, machine sitting there. In year 8, working capital is 0? Yeah.
You're not operating the machine anymore. so
Yeah,
it's
correct. It's done. I don't need any raw material. I don't need any labor. We're done, right? Everything's sold off. This project is completed. So it makes sense that goes to 0 by the end of the project's life. Okay. And in other words, the investment capital is completely recovered at the end of the project's life. So I'll explain what that is when we actually get into the calculation. Capital cost allowance, CCA, again, oftentimes we just call it depreciation, of the $800,000 machine is based on the amount allowed by the Canada Revenue Agency, CRA. CCA calculations are shown in 8.3 table, which is in the textbook, based on class 8, 20%. So, mind you, in this class, I'm not going to ask you to memorize the text code. Okay, this is a finance course. I know the textbook that we have assigned to you is a Canadian version, so there's a lot of tables saying, this machine is a class 8. I don't care. In the exam, I'm just going to tell you 20% depreciation rate, just to simplify things. Okay? So all you need to know is a 20% depreciation per year. Okay? That's the case. Now, let's move on to how to calculate this thing. If I ask you, please, in the Quirkus.
I have a question.
Yes, please.
Sorry.
Oh, yeah. Please.
I didn't miss this, but you said it's 20% depreciation, but didn't they already tell us what it's depreciating?
Nope. Nope.
Oh, market value. Okay.
That's the money that you can sell for after the end of that's a salvage value. Okay? Depreciation is a non-cash concept.
Got it.
All right. Great question, though. You can have discrepancy. That's fine. All right. Great question. Any other question about the case? Sorry if I'm going too fast. I just did this 9 in the morning, so I'm doing it. Please, 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 let me know if I should slow down or repeat myself. I have no problem. All right. I know how to do this, but you guys need how to do this. This is a lengthy process, which is sometimes considered pretty mundane, but I want to show you how to effectively do this so you can score perfectly in the exam. And more importantly, I want you guys to understand the concept of the thing. Why do we care about capital budgeting, and how do we do this? Okay, now everything is presented to you through the case. Now, if you can please turn your attention to Quirkus, I have uploaded two Excel sheets. One is blank, the other one is completed. The blank one is for me to show you how I'm going to start from 0 to complete. The complete one allows you to study on your own when you guys have time. Okay, a couple of things before we start. There are a couple tabs here. We have the cash flow tab, we have the production forecast, we have the CCA table, and there's the tax shield. I talked about the tax shield on Thursday. For today, I'm only going to talk about the cash flow, production forecast, and CCA. For the cash flow tab, I apologize here. For my lecture slides, I use the word OCF, operating cash flow. I don't know why I put CFO here, just cash flow of operation. So some people use CFO, OCF, but it's the same thing. Cash flow from operations or operation cash flow. So the first table here you see on the top is the cash flow from operations. These are all the cash flow generated from day-to-day business. Now, investment cash flow or cash flow from investment, this is where the firm invests in assets. So these are not the day-to-day, but these are the capital that you have to commit to the project, including the machine, including networking capital. You must commit to it before you can actually start producing things. And then eventually I'm able to come up with the incremental cash flow table, which is down here, and ultimately we're going to find the net present value and the IRR. So which is consistent with my slide, which I showed you earlier here. So these are different parts. So in your mind, you should be having a clear mind in the step-by-step process in order to build one table at a time until you get to the end, which is to find the NPV or the IRR. So now we're going to start with the first one. All right, so in fact, I should move these slides around. I would suggest we start with production forecast. We'll see it, okay? Going back to the case again, this is a forecast. It's not for sure. The manager did their best ability to predict 8-year lifespan, and every year they're going to produce this amount of numbers, 6,000, 9,000, 12,000, 13,000, etc. So, what we're going to do now, excuse me. Now, we're going to turn our attention to the forecast tab, production forecast. The outcome of the production forecast is allow us to figure out what would be the projected sales and the projected costs. Because the case or the manager have decided what is the estimated production number, so the production here, I'm basically just copying from the case. So please do it together with me. This is the only way you would learn. Again, I'm happy to slow down or repeat myself if you guys run into any obstacles. So 6,000, 9,000, 12,000, 13,000, 12,000 again, 10,000, 8,000, and 6,000. And please let me know if I'm doing anything wrong here. Sometimes I got typos and stuff. Okay, these are production numbers. We talked about price. The manager decided that the first year they're going to sell it for $100 per unit, correct? And then the price is going to increase by.
My fault, it's 10,000.
Yeah, you put 1,000.
What is that again?
10.
10. Okay, thank you. Yeah, I told you I got typos, so thank you for pointing that out. Now, price, we started at $100 per piece. However, I'm lazy. I can do it by hand. I can add 2% every year from year 1 to year 8. What I did here, because I'm using Excel, so I'm going to go a price increase of 2%. And what you can do with this is you can use formula. Equal to the previous price times 1 plus the 2%. You see that? Then what I can do, I can just copy and paste down the row. So the 2%, I want to anchor it so it doesn't move. Now I would go enter, yes. So $100, 102, and every year is going to grow by 2%. So year 3 is going to be 104.04. And again, this is just simple Excel operations, okay? What I would suggest, Excel is not part of this course curriculum. I'm not gonna share too much of Excel tips and tricks. However, please go to the bridge, the workshops that they host. They will show you all the tips and tricks on Excel. Otherwise, if you wanna ask me after class, I'm happy to explain that. But here, you can use the formula to finish that row, or you can just do it by hand. So now we have production unit and price. We can get sales revenue. What is sales revenue? Sales revenue is just the number of production times price. Done. Okay, let's take a pause for 10 seconds. Pretty straightforward up to this point. Any questions? I'll give you guys a few seconds to catch up. All right, moving on to cost per unit. Cost per unit, $64. This is based on the case. Again, going back to the case here, you can see $64 per unit. And the cost is growing by 5% per year. So 5% per year, I would use the same method here, inflation, 5%, and annual growth 5% of that. I would just do the same formula, equals $64 times 1 plus 5%. And here I'm gonna anchor it again, enter. And I can copy and paste for the rest of the rows, just like that. Make sense? All right. Now, I have cost per unit, I can calculate the variable cost. The variable cost is basically production number times cost per unit. Okay? Fixed costs. What about the fixed costs? It is mentioned in the case. The fixed costs will be $50,000 each year. So all I have to do is put 50,000 and just paste 50,000 across. All in all, I got variable costs, I got fixed costs, so the total operating cost of that will be sum of these two. Okay, done. That's my first step, is to estimate my production costs, ultimately getting sales revenue and operating costs over the years. Again, these are projections. I'm guessing, right? My best guess. Okay, what am I gonna do with this afterwards? Now we're gonna move back to the cash flow tab. We're gonna start filling out this cash flow from operations. You can see here, this looks like a classic income statement. You have sales, cost, depreciation, EBIT, tax, and ultimately you get net income. So let's copy and paste the numbers that we got from the production estimate tab, the production forecast tab, into this table. The only thing is, for the production forecast, I have everything in vertical. Now cash flow, I have everything in horizontally. This is a bit annoying, but you know what? You can just copy and paste each of these items, or I'm lazy, so what I'll do is I'll just copy this and transpose it into that tab. Again, it's an Excel thing. I'm not gonna go over it here in detail because these are tables, so what I usually do is I would just paste the numbers here, copy these numbers, bring it back here, and starting from year 1, I can paste transpose. So there we go. Again, I'm going a little fast. This is Excel, but I'm not going to go into the details of Excel. What I'm trying to do here is take the production forecast sales revenue, which is this column, and paste it here from year 1 to year 8, and the number should be the same. You can do it by hand. You can do one by one, copy and paste. That's absolutely fine. But if you know how to use Excel, you wanted to do a transpose paste, just faster. Similarly, I have operating costs, which is here. Operating costs, copy. Just gonna paste numbers here. Copy this guy. Go back to this tab. Paste transpose. All right. So I got sales and operating costs. I like to make it a little bit clean, so what I'll do is, you know what, I'm just gonna format it. Everything is in currency, 2 decimal place. Now it's nice and pretty. Okay? Any question up to this point? That's basically the first step. Good? Okay. Now, moving on. We're gonna figure out the depreciation, capital cost allowance, which is this line. How do we calculate depreciation? This is something that you should have learned in your accounting course. So I'm gonna go on to the third tab, which is the CCA tab. You can see here, capital cost allowance of the $800,000 capital investment is based on the amount allowed by the CAR, which is 20%. It's a straight line rule, straight line depreciation. Year one, started with $800,000. What's the depreciation of that? We can use Excel, equal this guy times 0.2, 20%. Enter. The depreciation is 160,000. What's the ending capital cost? So the beginning minus the allowance, so equal 800,000 minus 160,000. We good? Now, year two, what is the beginning cost of year two? That equals the ending of year one. And then from here, what you can do is you can drag this cell down and just fill in the rest of the table. Again, I'm going very fast because I didn't get any response. I assume you guys can understand it. Otherwise, let me know. I can redo this. Yes, please.
I just had a question on the production forecast.
Yes.
Is the reason we don't apply the inflation twice because we're applying it to like the cost per unit, so it's already applied marginally? Because like with the 5% inflation rate, like 400,000 year one is more cost heavy than 15,000 would be in year two.
Sorry, can you speak up a little bit?
Is the reason we don't apply the inflation rate to the operating costs at the end because they were applied in the cost per unit, so they're already factored in marginally?
No. Well, you're talking about the operating costs here, right?
Yeah.
Operating cost is basically variable cost plus fixed cost. Variable cost is just in unit that you produce times the cost of material. Cost of material in year one is $64. Grow by 5% every year. So we already have it here, growing 5% every year. Hence, the variable cost is just the unit times the cost per unit. There's no other inflation to apply here. Well, the only thing that I can understand why you would ask is shouldn't fixed costs also grow by inflation? But the case didn't mention that, so let's put it in. All right? So ultimately, the operating costs will be the sum of variable costs plus fixed costs. Did I answer your question?
Yeah, like my question was mainly stemming from like that money should be worth less, like per dollar each time. So that's kind of what I was confused.
Okay. So great question. You a step with everybody else. So what we're trying to calculate here, these are all future values.
Oh, okay.
Because at the end, that's when we calculate net
Oh,
present
okay.
value.
So you discount back at the very end.
We are doing everything in future value. All right? Good stuff. You're a little bit ahead. But everyone else, I want to make sure everyone else is good with this. Okay. So make sure you can replicate this depreciation table. All right? This is important because ultimately what we're trying to figure out here is the depreciation amount, which is in the middle here. So what we can do here is to copy and paste the depreciation amount in this table with the CCA starting year one. All right? I'm going to change up the currency. There you go. So it's the same number. Year one, 160,000, which is 20% of the 800,000 machine. Year two, year three, year four, these are all the 20% straight line depreciation. Okay? Any question with that? Now, we have sales, operating costs, capital cost allowance, which is depreciation, we can now calculate EBIT, earning before interest and tax. How's EBIT calculated? It's like a normal income statement here. Just sales minus costs minus depreciations. All right. Drag it across. That's EBIT. Is that okay? Now, with EBIT and tax, (40% tax). So we just have to apply the 40% tax here, equal EBIT times 0.4, 40% tax. I'm gonna drag this across 8 years. That's the tax amount, and hence, now we're able to calculate net income. Net income equals EBIT minus tax. Okay? I'll pause here for a second. Any question up to this point? Yes?
I'm just wondering, if there was a question like this on the final exam, would there be like one question that would take up the span of all the time, majority of the time?
I told you, at least half an hour. Yeah,
So there would be like multiple of these questions, or?
possible. Yeah, I've seen that in the past exam. So that's what I'm saying, like, most of people struggle in this course is because of this part of the course. Because everything leading up to this point is capital budgeting, and these questions are not easy. First of all, the questions are all in words. You have to understand the entire scenario. A lot of people don't spend time reading the question, misunderstood the question, everything got wrong. Assuming that you got everything right, you have to start constructing these tables. Starting from production forecast, depreciation schedule, then constructing the OCF table to find net income. And we're not even done yet. We're only 1/3 of the way. Yes?
How long is the exam?
How long? In the past is 3 hours. But I don't know. I might actually change things up for this.
More or less.
Yeah, more or less. At least 2.5. I'll give you guys 2.5. Because I know in the past, students struggle. They need more time.
Yeah.
I told you in the past, the final exam is only 4 questions.
Yeah.
Yeah, 2 hours, 3 hours is not enough for 4 questions. So you have to be very comfortable with this, and you see the question, you'll be able to attack it right away. If you sit there and you don't scribble, it's gonna waste time. However, I'll be honest with you, this question here, there's 8 years, so there's a lot more calculations, right? Although I've seen this in the past exam, 8 to 12 years, and you have to do this by hand. I'll be a little bit more reasonable. I try to control it under 4 or 5 years. All right? Something at least is more doable by hand. All right. Any other questions regarding this? This is basically the first 1/3 of the step. Good? Okay, why don't we do this now? I know it's been tough. I'll take a break, all right? Right now, just rest your brain a little bit before we get into the next step. Meanwhile, I can start giving back your midterm test. All right. So if you guys want to come forward, tell me. Again, I know you guys are excited about the midterm, but the final is going to be worth a lot more, right? And again, what we're going to talk about today is going to be a big part of the final exam. So you definitely want to pay attention today to the rest of the class. So the first half, before the break, we talked about how we construct the cash flow for operations, so that is completed. Now we're going to move on to the second part, which is the investment cash flow, or cash flow for investment. There are a couple items that you see in this table. The first one is net working capital, and then the change of net working capital. You got equipment and the salvage value. Okay, so a couple of things. We're going to start off easy. We're going to go with the equipment. Where is it? All right, equipment. So the equipment, based on the case, is gonna cost $800,000. So remember, this is cash flow. It has to have a direction of cash flow. So the amount is negative 800,000. That's how much it costs right now, year zero. It's gonna cost you negative $800,000. And the salvage value given by the case, how much you can sell it back for, $134,000. So that's a positive amount that you're gonna get at the end of the project. Now, this is the part where most students would get tripped up. So again, I would like to have your full attention how this is being done. So in the case, it does say that in the initial of the project, it costs $40,000 net working capital. Again, what is that being used for? Electricity, labor, raw material. You need to spend this money. And this is an asset, right? So the net working capital is $40,000. Is an asset, that's positive, is an asset. However, starting from year one, the case also say that from year 1 to year 7, the working capital, the net working capital equals to 15% of the projected sales. So equal, what's the projected sales? We can use the table up top here. $600,000 times 0.15, 15% of sales. All right. Sorry, I'm just gonna remove these guys. All right, so year 1, net working capital is $90,000, which is 600,000 times 15%. Similarly, you're gonna do it for year 1 to year 7. So you can now drag across. Basically, these are all 15% of sales. So you can click on the cell, verify the formula, making sure everything is correct. And then, in the case, it also say by year 8. So I'll highlight what it is here. All right, there we go. Management believes that the investment in the different items of working capital would total $40,000 in year 0, stays at 15% of sales at the end of each year, and falls to 0% by the project's end. Meaning year 8, it's gonna be 0. All right, we good with that? Any questions with that? Now, this is the tricky part. Net working capital is not necessarily cash flow. We need to figure out cash flow. So the cash flow is really the measure of change of net working capital from year to year. That's what we are measuring here. So the change of net working capital in year 0, the $40,000 is something that you have to pay, right? It's an outflow. Raw material, labor, electricity is an outflow. So 0 minus $40,000 equal 0 minus $40,000. It's a negative $40,000 in year 0. It's an outflow. Now, how about year 1? What is the change of net working capital from year 0 to year 1? That's the value of net working capital of year 0 minus the net working capital of year 1. You're gonna ask, like, why? Why 50,000? So if you look at this number here, if the asset is $40,000 in year 0, and year 2 it went to 90, how much more money do you have to pay to make it to 90? You have to spend another 50 grand in order to get it to 90. So it's an outflow of $50,000. And similarly, you would do that calculation for all the years, beginning minus end, and what you would notice, a very interesting pattern here. In the initial of the project, you're gonna spend a lot of money because you're gonna ramp up production. I'm gonna buy a lot of raw material, I'm gonna pay labor to meet the demand because I'm actually increasing this production productivity in the first couple of years. And what happens after the peak? Things slow down and my net working capital starts to become positive. Then now you're gonna think, why is that the case? How is that possible? Why has net working capital become positive? Think about the formula that you guys just mentioned. Current asset minus current liability. You started selling off these inventories, right? You stop buying raw material, and you just having a built up of inventory, now you're collecting cash, right? Or you basically stop buying stuff and now you start recuperating this net working capital. Okay, so that's what it is. Eventually it becomes positive, negative, it becomes positive. That's the change of net working capital. I want to make sure that you guys understand that concept. Now, after these 4 lines, I have net working capital, change in net working capital, equipment and salvage value. Now for the investment cash flow, this is ICF. ICF only cares about the cash flow, which is change in net working capital and any asset that you have invested or sold. So in that case, it's the sum of the last 3 lines, which is this. All right? So add them together, drag it across from year 1 to year 8. That's the amount of ICF. Any questions? Okay. So that's the table. We're now completed. We're going to move on to the next one. Now, this is called the incremental cash flow. That's fine. I'll just show you how to do this. Okay, incremental cash flow is the combination of OCF and ICF. All right. However, OCF, here's the deal. What we have in this table, this is net income. But it's not really net income we care about. It's the cash, because net income includes depreciation. So there are 2 ways to do this. All right, OCF equals net income plus depreciation. Because we want to add back that non-cash expense. Or revenue minus cost minus tax. It's the same formula if you look at that table. All right, so you can either go from the first line all the way down or work backwards using the bottom line and add back depreciation. Either way, it's going to work. That's how we isolate operating cash flow. Okay, so going down here, I'm going to do a top-down approach. I'm going to start with revenue minus cost minus tax. So because from the first table, we already have revenue, just gonna copy this guy, gonna move it down here. Costs we have, which is here, copied, move it down here. Tax, it's already done as well. I'm gonna copy that. Gonna move it down here. All right. What is the operating cash flow? Equal sales minus cost minus tax. Sales minus cost minus tax. That would allow me to isolate the operating cash flow. All I have to do is to drag this across, and I have 8 years of operating cash flow. Investment cash flow, because we already calculated here, we just copy these guys, bring it down here. All right, so we have OCF, ICF, and the total project cash flow is the sum of the two. So we go equal sum of the OCF and the ICF. Drag this across. There we go. That looks like our classic cash flow problem. Initial investment, 840,000. Every year is going to be positive cash flow until the end of the 8th year, which the machine is supposed to expire. All right? So where do we go from here? It's easy now. The last step is to calculate the net present value for this. Okay. Before we do that, I want to show you the net present value, how to do that on the calculator, right? Because on exam, you don't have Excel. You're going to do this on a calculator. So what I'll do is I'll go to cash flow, discuss some examples that I used in the previous class. I'm going to cancel everything. Oh, sorry. Show you my calculator. So please, try this on your calculator. Punch this in and see if you can get the answer that I'm getting. Can you guys see it? There you go. Okay, so cash flow, let's take a look at this. The total project cash flow, the first year is 840. I'm just gonna round this up, if that's okay. I'm just gonna round it to the 1,000. Negative 840.
You can't see the screen.
You can't see, oh, sorry. Now? Okay, let me just restart this. Cash flow, second clear work. Everything in the calculator is cleared. We're gonna start with the first one. Initial cash flow, 840. I'm just gonna do the thousands, okay? I'm lazy. Trying to be quick here. Negative 840,000. The next year, year number 1, we have 113.6 in the thousands. Year 2, 161.4. Enter. Year 3, 202.4. Year 4, 233. Just rounding this up. Year 5, 227.6. Year 6, 192.6. Year 7, 146.13.1. Year 8, 341.9. Okay, so I all entered 8 years of cash flow using the last line, the total project cash flow. So it's always a good habit to kind of scroll through them again, make sure all the numbers matches. 1614, 224, 233. Okay, everything looks good on my end. Now we're ready to calculate net present value. So to do net present value, you click on the button, net present value. Now you have to put in a discount rate. So in the example here, I want to have a couple scenarios. What's the NPV if interest rate is at 4%? So enter 4%, down, compute NPV. So I have 497.6 thousand. All right, this is rounded up to the 1,000. Now in Excel, it has a very handy function as well. It's called an NPV function. You can do it in Excel. However, interestingly, there's a flaw in the function in Excel. This is sort of, I don't know if it's by design or not. The Excel has an NPV function, so if you actually click on the cell here, go equal NPV. So you will see the function returns the net present value of an investment based on the discount rate in a series of future cash flow. All right, that calculates NPV. Funny enough, you can Google this, you can ask ChatGPT, it is an error. It only starts from period 1 and above and beyond. It does not include time 0. This only applies to Excel. Again, Excel is not part of the curriculum, but if you are doing Excel, that's why I'm explaining. If you look at the complete model, you'll see that it doesn't include the initial cash flow. So what I have to do here is to do NPV, and I will do the NPV from year 1 to year 8, and then minus, or plus, sorry, year 0. So that's the adjustment happening, because it actually does not include the present value, which is at year 0. This is an Excel thing. But if you do this, oh, what did I do wrong
You
there?
should put the rate.
Oh, okay, I didn't put the rate, you're right, thank you. So I'll put the rate here, which is 4%. Oh, sorry, I should turn on the screen so I can see. Okay, what did I miss? Equal NPV. Put in the rate, which is 4%, and then it will be from year 1 to year 8 cash flow. And then I would plus the year 0 amount. There we go, 497.65. So it actually matches my calculator. All right, it matches my calculator. 497.6, not close enough because I rounded up using the calculator. All right, so the cool thing with Excel is that you can use Excel to set different scenarios. What if discount rate is at 4%? What if discount rate is at 10%? So I can actually modify this to anchor B41, and now I can copy and paste down this to see the scenarios. Oh no, that's not right. Anchor the cash flow and anchor the B41. I can now copy and paste to see what happens to net present value if the discount rate is at different value. So you can see, remember the concept, the lower the discount rate, the higher the value. The higher the discount rate, the lower the value. So you can see that this project will be profitable, the most profitable, when discount rate is at 4%. As discount rate continue to increase, the value of the project will diminish and eventually become negative. So if the discount rate is 20%, should you take the project? No, you're gonna lose money, right? So that's how you would do it. And the last one, IRR. IRR. So on the financial calculator, how do you calculate IRR? We already have all the cash flow that is installed in the calculator, so all we have to do is press IRR and hit compute. All right, IRR 15.32%, 52%. So there was a question in the 9 o'clock class, how are you gonna calculate IRR without the financial calculator? You guys remember? How do you calculate the IRR without the financial? Yes.
Trial and error?
Yeah, trial and error. They're 8 years. Good luck. It's gonna take another half an hour. So don't cheap out on a financial calculator. You won't be able to do it. The question is, what is the IRR? Yes, it's doable, but it's gonna take half an hour. Okay. In this case, in Excel, IRR, you can go equal IRR. All right, there's an Excel function of that. And you can just highlight the entire cash flow from year 0 to year 8 and enter. You can see is 15.33, which matches what I have on my financial calculator.
Oh,
Yes?
sorry, can you go over like the net present value you did?
Yes, of course.
What about the Excel formula?
All right, about the Excel thing of net present value. So let me go over that again. Again, I'm happy to do this, so please do not shy and ask me to redo. Net present value, how do you do that in Excel? You can do that equal NPV. It is a function that is available in Excel. It would ask for a rate and it would ask for a series of cash flow. But the problem with this guy, if you actually click on to the help function, oh, what happened? It usually works. I don't know what happened here. Anyhow, normally if you click on this, it would tell you, the help function would tell you how the NPV version works. So maybe I'll try here. NPV function, there you go. Okay. The problem here with Excel NPV function is that it would not consider year 0. The series that you put in would assume is year 1, year 2, year 3, year 4. Just ignore year 0. I don't know why. That's how they design it in Microsoft. So your answer will be different versus using this if you don't adjust it for year 0. So what you do here is instead of, put in the rate and the series of cash flow, instead of going from year 0 to year 8, you go from year 1 to year 8. That's your present value from year 1 to year 8. But then you have to also add back year 0, just because Excel doesn't do that. You would have to add year 0. So that way you get the NPV. Okay? I don't know why it's an Excel thing, but don't worry, that Excel thing is not part of the course curriculum. If you do it normally like you would in the calculator, you would get the correct answer. So again, I have all the cash flow inserted into the calculator. All I have to do, NPV, I equal 4%, compute, it is 497, so it matches my adjusted formula in Excel. Did that help? Okay, anyone else? Questions so far? All right, we're almost near the end here, hang in there. All right, so that is how we would calculate the capital budgeting question. You can see from this example, it's a lengthy question. It will take half an hour or more. So you will see similar question here in the final exam. Please, please, please read the case, all right, in the textbook. The other thing I want you to focus on, don't feel so dragged down by all the moving part, the calculation. Focus on the big picture. This is actually really fun stuff. Why I say that? For those who want to be in investment banks, this is what they do every day. This is literally what they do in investment banks. I was sharing my story with the morning class. I think this has to be 6 years ago, before COVID. I have a student who's a UTSC student, undergrad student, one of the brightest students here. I have a friend who's 10, 20 years older than me. He has a startup. He had an AI company that would price airline tickets for corporates. So these are like internal air tickets that for their employees to fly to meetings and stuff, whatever, right? So he had this AI software. He wanted to actually price it because there are buyers who wanted to buy this company. So there was an M&A, but at a very small scale. He came to me, he's like, oh, you taught finance. I'm like, yeah. He's like, I don't know how to price this thing. I don't know what's a price to ask for. I want to sell this business. So I'm like, at the time I was too busy, I can't do this for you, but I have a student who's really smart. You want to work with the student, but you got to pay the student. So I asked him, you got to pay him at least RA rate. So he's like, yeah, sure, I'll talk to the student. So the student worked for him for, I think it has to be at least 3 to 4 months, in trying to do exactly that, is to estimate what is the revenue, how much income are you generating from the software, what is the cost, how much do you pay engineers, what is the inflation, what is discount rate. He did the whole model, just like how I showed you. And the outcome was, my friend got to sell his company for $7 million. Not a whole lot, but it's a small M&A. He's happy, he sold the company for $7 million. He cannot thank the student more than enough. And the student just had B10. You guys just took and able to do a model. So the skill here, what I'm trying to tell you is, you have to understand the whole thing, why this works, and finance is an art. I've been telling you finance is an art. Is this going to be true? No, because it's all happened based on assumptions. The assumption was 2% price increase. The assumption was 5% interest rate, or 5% inflation rate. The assumption was they're gonna sell 6,000 units in year 1, 9,000 units in year 2. These are all based on your industry expertise. The finance piece is just how to put this together, right? So there's no right or wrong on these things, and most of the time, a model like that is used to convince clients to make things happen. See, you know what? This project should be invested. And you can actually use this as a legitimate proposal to go to client, or go to your boss and say you should invest in this project. So that's the fun side of things and why you should learn this. And I'm just hoping that I'm able to inspire you to think a little bit instead of resisting. It's like, oh my God, like accounting, finance, what do I do here? This is an everyday thing. It can be as real as possible. You think this is a textbook example? This is being used in real life, every day, all right? So I hope that helps. Another thing before I wrap up, again, if you're adventurous, right? You want to do a little bit more. Again, this is basically the entire table. So what people usually do, right? You can actually do a whole scenario analysis. You can actually have scenarios. For example, my model is not dynamic, meaning that it's actually hard-coded. If you want to change it, right? This model can easily be dynamic, meaning that every cell is connected. I could just change price increase. Well, you know what? I'm gonna have different scenarios. If this is a base case scenario, price increase 2%, inflation 5%, this is base case. I wanna make a worst case scenario. Worst case scenario, price increase 1%, inflation 6%. Then you would have a different value of this project. And then you can have a best case scenario. Price increase 3%, inflation 4%, you can have another value. So what you do eventually, you can have a range of value based on the different scenario. Again, you can go to your boss and say, you can even assign probability. You know what? 30% chance is gonna be a worst case scenario, 50% chance is gonna be base case, 20% chance is gonna be a best case. Average it, this is the amount. Again, it's up to you how you're gonna pitch this, but this is the operational part of it. But the big picture is this is extremely powerful tool. All right, last thing here, I mentioned operating cash flow, right? Different ways to calculating it. And a special note, all right? You notice that we have not talked about interest rate at all in this calculation. Isn't interest rate an expense? Well, interest rate is excluded from the cash flow related to this project because of two reasons. Interest expense is a financing cost, not an operating cost, so it doesn't go into OCF. And secondly, the cost of finance can be used or incorporated into the discount rate. So again, what is discount rate again? If this is the money that costs you, right? Let's say it costs you 8% to finance this project, then you can use an 8% discount rate. If it costs you 12% to finance this project, you can use 12% discount rate. So depending if the money is cheap or expensive, then the value of the project is going to change as well. You can totally make this model dynamic, and it's going to be a lot more fun. All right? So again, I'm going to stop here. The rest of it I'll cover next class, which is Thursday. Before I let you go, I want to make sure that please, I know I keep repeating myself, read the textbook example. This guarantee will be an exam question. I will give you some practice exam besides the end of chapter questions. I have some harder ones that is from previous exam. If you can do those, you guys are going to be fine in final exam. But you do have to spend time to do it. If you don't get everything I'm showing you today, don't even bother coming to class Thursday. You won't get it. Because on Thursday, everything is based on everything we talked about today. It's the same case, but there's a different approach, which is a more complicated approach. So please catch up before Thursday's class. Thank you again for accommodating the schedule change today. I'll let you guys go a little bit earlier, and I'll see you guys on